I hereby introduce to you Mr. Michael Veazey.
Today's show is brought to you by Amazing FBA's mentoring program. So I'm kind of sponsoring my own show. I just wanted to briefly tell you about the mentoring program because it's about to go away at its current price point and in its current form. The mentoring program is there very simply to get you launched, like pretty much everything I do for the more, early days sellers, apart from the 10K Collective, which is obviously for people doing very, very well and ambitious to scale. Everything else I do is really geared to helping you get launched with your first private label product within probably 6 months, maybe 9 months if you're really busy and have other projects on the go. So if you want to work with me for £300 a month for 2 90-minute sessions plus email support, that is the current offer. I'm going to take one more person on, maximum 2 if the other candidate is really, really special and looks like a really great person who's going to succeed. Either that or by the end of June, one of those, whichever comes first. Then after that, I'm going to yank the mentoring program at that price point. And when it goes back up, it's going to be part of a bigger, more powerful package, including an online course, which I'm very excited about. And it's going to be at least £500 a month, probably more, because I'm putting a higher value on my time because I realize opportunity cost is a real cost. And hopefully you realize that as well. So if you value your time, there are 3 things you need to have to even apply for mentoring. You need at least £5,000 in inventory money. That's not to cover your training costs with me. That's additional, but just for inventory, 20 hours a week to devote to building a business, and 6 months of your time to devote to it as well. Otherwise, I think you're just wasting your time, and I won't take you on because I don't want to take your money for the sake of it. I want to take your money only in exchange for great value and you creating your business finally getting off the ground. So amazingfba.com/mentoring if that interests you. Otherwise, on with the show. Thanks for listening. Ladies and gentlemen, welcome back to the show. I'm delighted today to be talking to Matt Ward of FBA All Stars. So there's too many amazings knocking around. FBA All Stars, the podcast all about Amazon, and who has built and is in the process of pretty much selling, has pretty much already sold his Amazon business, and is the growth guy at Call, which is a business that basically funds, I think the phrase was, anything that's less than $1 billion business that VCs or venture capital won't touch, and also probably that banks will be very wary or reluctant to give money to as well. Is that about right? The summary there, Matt.
That's a solid summary. Basically, if you haven't been around for 2 years with tax history and all the good stuff, then a bank's not going to give you jack, unless you're willing to put up your house and potentially go homeless. And VCs aren't going to fund anything that's less than like $1 billion type outcome, because the way their investing works, it's power law dynamic. The 1 or 2 investments returns the fund times like a bajillion times over, which is how they make all of their money. You think about the Ubers, the Facebooks, that's where the money's made, is the massive win. So we're funding companies that are kick-ass companies. Like my company would have been a great example. We're funding companies that are building businesses that are solid based on revenue and good fundamentals. And we're just pouring fuel on the fire without taking any equity or any of that junk.
Okay, so what sort of businesses, first of all, would you fund? Is they got to hit a certain? So you've talked about they don't need presumably 2 years of records. If you're saying that the banks won't touch them without that, implies you would. So is there a certain length of time in business? Is a certain revenue number? What other metrics would you look for to consider funding businesses through your entity?
We basically have 3 easy guidelines. They've been making money at least 6 months. Their average revenue is at least 10K, all the way up to 250K. We can cut checks anywhere from 4 to 8 times your monthly earnings, and that the gross margins are at least 30%, i.e. if you're running an arbitrage business that's really fine lines and you're skimming along there, then it's not something where you could afford the revenue share model. Basically, we inject a bunch of cash so you can grow the business way faster, pay us off a small revenue share, and then be way further along.
Okay, so let's take an example. Let's say that when you say making money for 6 months, you mean revenue or sort of profit? Because I know they can be quite different. Revenue. Okay, fine. Let's say I've been in business for, let's take the lower end first as an example. Let's say I've been in business for about 6 months, as in actually selling on something on Amazon, not researching for hours. Folks, that is not a business. You have to be selling money to actually have a business, selling things, I should say, for money. So you've done 6 months of revenue. You're doing about the $10,000 a month mark, and I want to expand to my next product line or two. How would it go if I sort of email you guys and say, okay, I want to explore getting a loan from you guys? How much can I borrow? What sort of terms? How does that all work?
We look at it as more an investment, just because you traditionally look at banks, you look at lenders, etc. They're going to give you some type of interest rate. They're going to secretly hope that you take extra long, so you have to pay off a ton of extra money, or that you fail and default so that they get all of either your inventory or your house, whatever you have as collateral. How our model works is, so you've got this 10K. That means the maximum we could fund you would be somewhere between 40 and 80K. That would be a decent injection. It would be able to launch, ideally, much more than 2 products, but regardless. So we inject the money, and then you pay off a 2 to 10% rev share. It depends on the business, the stage, the term. It lasts for 3 to 5 years. But so essentially, you've got a 30% gross margin. You're paying off 2 to 10%. So you're left with, 20 to 28% on the top, which is still pretty sizable margins. We want to make sure that the companies are able to grow and grow quickly without having the rev share affect them in any way, shape, or form. So you apply, the application doesn't take very long. You can fill it out in probably an hour, half an hour, 20 minutes. You integrate your APIs. So we have API access to connect to your banks, your bookkeeping. And if you pass, we have a quick call and you've got money in your account in 2 weeks. Then there's none of the, hey, what are you using this for? Hey, are you just funding these products? We try to be collaborative, because if we can help you grow the business, you have a bigger pie, which means we get more pizza too.
Okay, excellent. So how would it work, for example, if I borrowed, say, $80,000 against my 10,000 revenue, which I have to say, that's not even a multiple of free cash flow, is it? Does your cash flow have anything to do with the amount you guys would lend?
The cash flow is based off of the amount that we would invest in the company. But again, not all companies can qualify for up to 8x. It's dependent on the business, the fundamentals, how long it's been around, what the actual margins look like. Derek is better with those. He's very much on the machine learning side of things. And what we're trying to do is be more efficient than there's three revenue type lenders that we know about. One of them only deals with companies that want to raise at least $2 to $15 million. And the other one is kind of slow. And then we all know banks, which pretty much don't want to deal with small business at all. They gave up on that 100 years ago.
That's true. Yeah. Banks really, especially I have to say, e-commerce type businesses. I mean, I know that there are people in 10K Collective, the mastermind that I run for the more advanced sellers and the more serious sellers. There are people doing, they've been in business for generations, literally, and their model was e-commerce in terms of their own Shopify site. Now they're more focused on Amazon. Maybe it's partly because of that, but they're making crazy returns on the money. They're solid financials. They're growing fast, and the banks won't touch them, even though they'll lend something to the guy down the road with the brick and mortar store with all the overhead that implies and all the low growth or minus growth that implies as well. Is that backed up by your experience as well?
I was in a bank 2.5 years ago in a Bank of America. I was just trying to get a credit card. We were spending $10,000 a month on advertising, just on Amazon, and very profitably advertising. I could not get a credit card because I paid for my college with my own money, and I graduated. I didn't get a car because I traveled, so I had no credit. I had no history. They would lend me nothing. They would not give me a credit card. Eventually, I qualified for a $500 card, but I had to put the $500 up initially. And we're doing $10,000 a month in advertising, and
wow,
a large multiple of that in sales.
That takes a special kind of stupid not lend in that situation, I suppose, either that or a special kind of risk aversion. So you were talk me through the traditional options and how your model kind of fits into that. So it's basically revenue share is how you get paid back. So is it purely a debt position that you don't own any of the company, or is it an equity position, i.e. you take a percentage of the company's stock?
We don't take any equity. We don't take any board seats. Technically, you could call it a debt, although you don't actually have debt. It's a slightly different mechanism. I believe that the mechanism would legally be called debt, but you don't have debt. Essentially, if your revenue goes down to zero, our revenue goes down to zero. It's a rev share. Okay, it makes sense. Yeah, I mean, I've done revenue share deals with people before in exchange for managing their Amazon accounts, and I guess. Yeah, I wasn't really debt or equity in theory because I wasn't lending them money, but at least some of that is familiar. But yes, I guess kind of debt, but not debt. Interesting. So the alternatives would presumably be going to the bank for a loan. What are the other? I mean, you talked about VCs, venture capitalists that are not interested in businesses that aren't going to become the next Facebook or what have you, and don't have really crazy numbers in terms of revenue. What other traditional options would people have who are in the position of somebody saying doing between 10 and 250,000 a month on Amazon? You could try to go, if Amazon offers you lending. Now, The terms are going to give you are going to be interesting. PayPal, some of these other payment type processors might lend you some money, but it's not going to be a very large multiple. I remember the numbers we were doing in terms of sales. We were probably getting half a month's revenue in terms of how much they would be willing to lend to us, which just really is not all that helpful. Do you want to build a business, you need a little bit more money if you want to scale it faster. So it's steroids for business is pretty much what we're doing. Okay. If you went to your other options would be you've got a rich uncle, you find some other type of loan shark type investor that'll give you some money, but the interest rates that are just going to be out through the roof and the terms are going to be terrible. Or you go with a company like a Bonolo or somebody where they're giving you money for a specific product launch. Maybe you say, we want to order 1,000 of XYZ product, and then they vet it, and then the crowd invests for you to pay off of just that inventory. You pay that off of a pretty quick term, high interest rate, but it's just for a single product. And it takes a lot of time and effort to set up.
So Bonolo, I haven't come across Bonolo. Is that basically a crowdfunding for a single product, rather like Kickstarter or something like that? Is it the same thing?
I think they have a new name now. It might be Upfund or something. But yeah, it's a Kickstarter for a single product, and then you split the revenue with whoever's funding it. But I think there's pretty high interest rates as well, and it's also not a lot of money.
Yeah, that's interesting. And tell me about Kickstarter as an alternative. I know that you have your particular model, but I'm just thinking in terms of people who are considering various different options. Obviously, it needs to sort of fit into their set of options as to why they would go one way, not the other, I guess. So Kickstarter, is that something you have any experience of or any thoughts on relative to your model?
If you can do Kickstarter, that's a way better model. That said, almost no people could do Kickstarter Indiegogo because you have to be creating something, for the most part, that's very original, and you have to have really strong marketing. So the people that are running Kickstarter campaigns, they're much larger businesses these days. They're putting a ton of money into advertising and Facebook ads, and they're doing something that's actually original. If you're launching just another Amazon product, there's nothing exciting about that. Kickstarter is also very design and tech focused. So you'll see the people shopping on there are pretty much hipsters. So unless your product is designed for a hipster, it's not going to do very well on a crowdfunding platform. The other option would be giving up equity in some type of crowd equity raise, like with a Republic, with a crowdfunder, et cetera. But then you're giving up equity in your company. It has to have that potential for upside.
So what's the crowd potential raise one that you gave the example of? I didn't catch that.
Crowdfunder?
Crowdfunder, okay. Don't come across that.
There's a lot of sites like that. That said, most of them are only going to fund companies that are more original. It's essentially a VC, but for the people. So it's still focused on pretty large returns. You've got to have the potential to go relatively big for it to be interesting.
Okay, that makes sense. And I guess for some people they are very ambitious. Now, I have to say that I've worked with a Kickstarter business sort of pretty intimately for a while, managing their account. And yeah, there are quite a lot of problems with it. For one thing, I have to say that it looks like you have a lot of cash, and you do, but you owe every single penny of that quite swiftly to people in terms of products. And here's the problem with that as soon as you've fulfilled those products, you have no money left, but of course you need to make a reorder. If you do well, you particularly need to reorder pretty quickly. So I don't find that really solves the main problem, which is that, especially when you're launching a new product, you put, say 10,000 or 100, whatever the number is, 10,000 into stock for a new product. You need to put some money into marketing it. And then as soon as you've done that, if it starts to take off, you got to go and put in an order for 20,000 because you need to order more than you had last time. So that was my observation with Kickstarter. Can you speak to that? Is that accurate?
100% true. That's why Coral's interesting, because essentially it's cash on demand. You get the money within 2 weeks, and it's significantly more than you would get with other platforms, significantly faster, and it's a lot more transparent, so that you're able to get the cash and grow the business, because we don't want to focus on just freaking fundraising, and cash flow is a pain in the butt for e-commerce.
Yeah, 100. Yeah, absolutely. Not just 100%, but it gets worse and worse as you get more successful. And that's one of the things that Ashley Pierce, who I interviewed recently on the show for the 10K Collective, he's the classic person that is growing a business really fast. He got to 120K in December 2016, 2017. He grew it pretty sharply, so that in 2018 he's on track as a sort of run rate for about 750K this year. But of course, his massive barrier, the barrier of barriers, is going to be cash flow. So tell us a bit more about that. Can you combine these things in some kind of meaningful way for the really ambitious person? So Kickstarter is obviously only for something that's pretty original from what you said. Crowdfunder, it sounds like it's got to be original as well, and big upside potential. Is it possible to sort of combine a few things like Kickstarter and Core, for example? Is that kind of just going to create a real mess, or is that a smart strategy?
I think you could do it. So Coral's designed so we can work with VCs or other other investment partners. Really, it's designed to get you to cash quickly. In terms of how the revenue share works, if a VC wanted to come in, they could buy us out of that, etc. But for it to be effective, I don't think pairing Kickstarter with something would be that smart. I would say it would be more, your options would be something like you can do Amazon lending, plus eBay lending, plus PayPal lending, plus go to a bank, plus do this. Or you could do Coral because the amounts are roughly the same.
Okay, yeah. So Amazon lending, as you're saying, plus eBay lending, plus PayPal. You're saying they're
basically you could do that, or you could get lots of credit cards and play that game. But then again, interest rates are huge, and if you're in trouble, you're bankrupt.
Yeah, I mean that's the thing. Like playing the 0% balance interest game is not bad unless things go really wrong and you start hitting the point
really
where you can't keep transferring it. Yeah, I mean, if you got any stories about, if you heard of people really hitting the wall with that one, or is this just like a theoretical problem?
Well, I think if you keep opening up new credit cards, you're ultimately going to be screwed because you've got to be reducing the debt over time. Otherwise, it's just getting worse and worse.
Yeah, I guess that's true for all types of debt. So let's talk about that a little bit more. So obviously getting cash for funding massive quick growth, 4x, whatever it is, up to 8x of the revenue per month, of the monthly revenue, I should say. It sounds like an amazing enabler, and 2 to 10%. What sort of, if I ended up with that money over, say, a 3-year period, what sort of interest rate is that going to cost me roughly?
So we don't do interest rate. We have a repayment cap, which you can kind of correlate the two. But basically, depending upon the amount of money you raise, the stage of the business, the success, etc., the repayment cap will be somewhere between 1.5 to 2.5x. So if you got 100,000, you would pay back 150,000 or 250,000, somewhere between there. So an extra 50 to 150K.
Okay, and that would be over the course of what, about 3 years or something like that? I mean, I know these are extremely ballpark figures. I'm just trying to get a rough idea.
It would be over the course of 2 to 5 years, depending on how you wanted to set it up.
Okay, so it ends up being, I don't know what that is.
It's flexible. You can change it, you could extend it, etc.
Yeah.
There's no fixed payments.
Yeah, I mean, compared to quite a lot of loans, I mean, there's iWalker. I think that might be an EU only thing, but again, they offer fairly modest percentage of monthly revenue. About half is about what I've experienced, and they offer 3-4% a month interest, so that actually ends up pretty hefty,
ridiculous.
Yeah.
If you're giving up 50% of the business, I mean, you would have to have ridiculous margins for that to make sense.
Yeah, that's not good. It's not a great model for that reason. They keep trying to persuade me to take their loans, and I'm like, yeah, it doesn't really make any kind of sense at all, really. So, all right. So tell us what's the sort of bigger, the longer term picture. Let's imagine that Call, by the way, CORL, is that the right spelling?
Yes.
In case people are looking that up. We'll obviously have links on the show notes, which by the way, guys, amazingfba.com/Matt W for Ward, MATTW. We will have all the episodes there and any notes you need as well to follow through on any of this stuff and investigate it further. But let's imagine that you have, let's say we're less ambitious than you, which is probably most people, even the pretty ambitious people, and they want to build a business to the point within 3 years where they can sell it for, a few $100,000. So how might that work typically with Call? Have you got a sort of an example or a sort of typical way of doing it?
Yeah, so basically you've got a business going, let's say you're running, once you get up to the 10,000 a month in revenue, then you could reach out in terms of funding, and we would either accept or reject it. But essentially there would be a cash injection that would speed you up. If it takes you 3 years, you should definitely be able to get to a couple 100,000 guys. Think big. That's one thing we talked about a little bit last time. There's no rules, and I'll have a 10x type rule. If you have a goal, try to 10x it, and then figure out how you would have to do that, because you'll have to think differently to do it. And that's part of how Coral comes in, is thinking a little bit differently, because if you can sacrifice a little bit on the revenue, but be able to scale the business significantly faster, you're way further off at the same point in time, i.e. you just won.
Yeah, you just won. I like it. Yeah, I think one of the things that struck me most heavily about the discussions with the big hitters in a couple of the masterminds I'm either a member of or that I run, is that people get very, very into two things at the higher end, one of which is market share at almost all costs, as long as you don't go broke, which is a very important basic rule for everyone, which some people kind of forget. They get a bit excited. and they don't measure out cash flow in the future, if you start expanding like crazy, you may get to the point where you have minus 20,000 in the bank 6 months down the line, even though in theory 8 months down the line you're rich. So just bear that one in mind. Get a spreadsheet going, guys. It's my rule of thumb, and you might want to speak to that in a sec, Matt. But also, yeah, they seem to be obsessed with dominating a market. If it's valuable, because they know that even if there's some pain short term, if they're squeezing out competition, for example, that in the longer term it's worth a lot to them. And yet speed of expansion, those seem to be the sort of obsessions with the bigger hitters who they go on to make serious money. Have you got any thoughts on that stuff, especially the cash flow projection bit?
Make sure you're doing that and not screwing it up, because otherwise you'll realize you're screwed.
Yeah.
I would say that I definitely, when I was building my business, grew a little bit too quickly at times, which made things significantly more challenging.
Yeah. So fast growth does bring its challenges. So tell us a little bit more about the challenges of fast growth. Can't even say it. Never mind, do it. What are the main challenges of fast growth?
Let's say we've got 20K and we're going to launch 4 product lines. And it's awesome. We just put the money in. And let's say we got a loan from Amazon for 20K and we're going to launch 4 product lines. Even we're going to launch 3, whatever. We launch it, things are going well. Then we need to reorder. The challenge being we need to reorder those products and all the ones we already had as well. So suddenly we need way more money that we have in terms of cash flow. So right after that first set of inventory starts to get low, we're screwed because we don't have enough cash flow to actually support the business. So then we need another loan. Or we need to be smart and launch less products. Or we need to be smart and get more money initially.
Okay, that makes sense. So launch fewer products at one go or get plenty of cash. And would you say there's a sort of rule of thumb or a ratio or a 2x, a 3x, a 5x?
It depends on the products. It depends on how fast you're turning them. It depends on unit costs. It depends on lead time. So the longer your lead time is, the worse it is.
Yeah, that makes sense. So, I mean, one of the things to factor in, which is very, very important, and people don't really seem to factor that in because it's a cash flow. People get very hot on profit and loss. In fact, I would say, and again, speak to this, Matt, if you've got some thoughts on this, but my experience is that people micromanage their profit and loss to which is, important to a certain point, but don't really think about the cash flow implications, such that if you make a profit and loss of X, Y, and Z on your products over the course of 9 months, that's a hugely different scenario for if you can get the product, turn it around, get it out the door, and then go and reorder within 3 months, right? Any thoughts on that one?
Turnover probably trumps profit, because if you're sitting on your inventory, then you're going to find yourself in trouble eventually. So, I mean, if I can sell something profitably, but I'm selling it slower than if I'm selling it less profitably, you can kind of figure out there's going to be some type of curve where it's optimized. And you want to hit that optimization time speed.
Yeah, that makes sense. Yeah. So what would you say? We asked in the last podcast, I asked you really for your 3 biggest lessons learned from scaling a business from, start to selling within whatever it was, a year, 18 months, a crazily fast time. What would you say are your 3 top lessons for Amazon sellers in regard to funding and cash flow and this area that Call deals with?
I would say number 1 is don't get into personal debt. So if you find yourself, that's one of the things about Coral as well. There's no personal debt. There's nothing like that on you. If you get yourself in personal debt and you screw up, again, you're screwed. You're going to go bankrupt, or you're going to go live at home. Also, keep in mind that even if everything does go to shit, it's really not the end of the world. You probably are going to be able to live on someone's couch. But in terms of scaling up a business, I put 100% of the money back into the business for the first year and a half. I didn't touch any of it. I think that's 100% important. If you're trying to take money out of your business, then it's already just a lifestyle business that will never be anything. Now, make sure that you have enough money so that you're able to grow and scale quickly. Again, we talked about before, but ordering 2,000 units, I think that's very valuable. To have enough inventory, enough firepower. Obviously, it's dependent. If you're selling couches or something, you don't need 2,000 units. But you need to be smart at that and look at what the lead time is and order enough inventory. You need to have enough money on hand for when the reorders happen. You need to not launch another product line until you're able to cover that. And if you have the ability to take outside non-dilutive funding, that can be hugely beneficial for the business. Now, if it's dilutive, i.e. if you're taking on equity partners and giving away some of the business, then you need to really think about, is this the right time to do it? Or are we better off waiting? But I would say those I think that's got to be about 3.
Yeah. Okay. So don't take on personal debt. because you can end up homeless, which is fairly obvious. But I do know, particularly in America, it seems to be a real thing that personal guarantee is almost
we love credit cards. Now that said, get a business credit card, use it for Amazon ads. Get the Chase Sapphire one. You get 3 times the points, so you get tons of freaking flights.
Okay, Chase Sapphire, right? And I don't know if that applies in the UK, but that was one thing I was going to just double check about, actually. That does this stuff, all the call funding model, it sounds really fantastic. Is it only for US-based businesses, as in LLCs? In other words, they're 100% based in the US, or can it be applicable to UK limited companies, but which sell in America, or is it just worldwide? How does that work out?
We can deal with anyone who's based in or selling in North America. And depending on when you hear this, we can probably start dealing with European companies as well. So it's worth reaching out either way.
Okay. And when is this good stuff available? Because obviously I can see, a lot of the upsides for this. I can imagine quite a few people that I personally know who would be at least interested in exploring it. Let's put it that way. Whenever money's involved, a bit of due diligence is always a good plan, right? But it does sound very attractive. Is this already available to people right now, or is it sort of launching?
When will this episode go live?
This episode will be going live in sort of mid-June 2018.
It should be live by the time it goes live.
Okay.
If not, I would be surprised, and it would be within like the week kind of thing.
Okay, well, that's fine. I mean, if you're in that much of a hurry for the money, you might have bigger problems to solve anyway. But
yeah.
Okay, so anyone who's based in or selling in the USA, live from mid-June.
Or Canada.
Or Canada, okay. All right. Well, I mean, I suppose theoretically that could be good. I don't know anyone who's doing serious money in Canada, but hey, there might be somebody listening. And if so, I apologize, not just in Canada.
They're selling all of like maple syrup.
Yeah, it's a big old place to fill. I mean, it's even bigger than the States and far fewer people. So I guess harder to make work traditionally. But what about Europe? If somebody's selling just into Europe, surprisingly, I know a few pretty serious sellers who are just selling in Europe at the moment. Is that going to be coming down the pipe? If so, do you have a rough time frame on that?
Yes, pipe, time frame, no. I would say it's worth reaching out, because if you have a great business, I can probably convince our team to start taking outside of North American investments as well.
Yeah, well, I do. So I know 2 or 3 pretty solid looking businesses in Europe. So interesting. Okay, so it'd be worth them reaching out as well. Great. Okay. Well, I think that pretty much wraps up, unless I'm going to start getting really deep into the numbers, and then you're going to have to bring your numbers guy on, and it's going to get messy because numbers on a podcast don't work particularly well. That's my weakness.
Yeah.
Yeah. Well, no, numbers on a podcast also is not the medium for trying to crunch numbers. That's when you need to get a spreadsheet out. So I think that pretty much wraps it up for me. Very interesting model. Very, very good to know that there's another option out there. Even having an option is at least less frustrating than smacking your head against the brick wall that is the bank down the road, which generally just has the most closed-minded approach you can even begin to imagine, in my experience, and that of my friends who are doing serious numbers as well. So have you any parting thoughts for people who are scaling ambitiously and banging their head against walls, funding thoughts or other ones?
Yeah, so if you're a horse on a track, you're running with blinders on, and maybe you see a wall in front of you. My question, my last thing I would leave you with is to just stop for a second, take off the blinders, and see if there's a better way. I would try to get you to think bigger and think differently, because a lot of times when you do both of that, it takes about the same amount of effort to build $1 million business or a $10 million business or a $100 million business. It just takes a little bit of a different way of thinking. So I would invite people to think bigger, to think different. And if you're interested in learning more about startups or the future of tech and humanity, I run 2 podcasts, the Syndicate.vc, which is really focused on early stage tech. So focused on early stage companies, e-commerce, SaaS, space, all sorts of exciting things, the Syndicate.vc. And then I run another podcast, Fringe.fm. This one I'm launching. It's just now will be coming out. It's basically a long-form TED where I get the smartest people in the world and we have incredibly deep, interesting conversations on the future of mankind.
Wow. Okay. I'm just making notes here for Joe, my trusty notes guy. He's going to make very detailed show notes as ever. So guys, if you want to get your head around some of this stuff, amazingfba.com/Matt, WMATTW. And I'm just looking at the future of mankind is what I've just written down, which is talk about thinking big. I don't think we can go any bigger than that. So it just remains for me to say a couple of things. First of all, Matt, if people are interested to hear from you, and I'm certainly one of those, very impressed with the size of your vision and your cool kind of going past the normal blinders and the normal brick walls thinking, so thinking outside the box in a big way, where can people follow you and find out more from you? You've mentioned the syndicate.vc and fringe.fm. Those are the podcasts. Any other places that people can follow you?
You could go to Twitter. It's Matt Ward. I know it sounds super ego-y. No, the truth is someone else has the Matt Ward name. There's way too many people with this traditional normal white guy name. So it's Matt Ward. Or you can find me on Medium. I do quite a bit of blogging and writing on there. And then it's Medium/@It's Matt Ward. Those would probably be the two best places outside of the podcasts.
Great. Okay. Well, as a fan of podcasts myself and a fellow podcast, I mean, fellow sounds a bit cheeky. I'm not anything like as big a visionary as you. You've shaved me into
you're crushing
thinking.
it, man.
That's very sweet. But
self-deprecation is always challenging. Don't play it, because then you're already falling into something where it's not really true. You're just playing yourself down.
Okay, interesting. Well, for a Brit, I think that this, if we were talking about the difference between Americans and Brits last podcast, and I was feeling a bit ashamed to my crass comments, but you know what? You've just turned it around. The best of America is self-belief and the can-do attitude. And actually, Brits have a terrible habit of self-deprecation and saying, "Oh no, I'm shit, really," even when we're doing millions. Never mind anything else. So, thank you for calling me on that terrible British habit. Very grateful to you, and very, very grateful to you for coming on the show, Matt. It's been mind-expanding and really fun. Love to have you back at some point. In the meantime, great luck with Call and, of course, your new podcast as well, fringe.fm. Look forward to listening to that. I'll be an avid listener of that as well. So thanks so much for coming on.
Awesome. Thanks for having me. And by the way, I forgot, it's coral.io, guys, not coral.com. Check it out if you're interested in funding.
Coral.io. Thank you very much. And again, that will be at the show notes, amazingfba.com/Matt W. Matt, thank you so much for coming on the show.
It's been fun. Thanks for having me.
My pleasure.